Welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with our guests Tyler and crew from Blackpier Capital, I think. So before we get started, a quick disclosure: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. If you don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And this is for educational purposes only. So with that, I'm going to stop sharing my screen. If I can figure out where that is here. Oh, maybe I never shared it. I guess I didn't. So I guess you guys can share your screen if you want to show your slide.
Sure. Yeah, let me I can do that real quick.
And Tyler and the gang, I guess this is the first time you've been on the roundtable, so maybe just a quick intro of who you guys are, what you do, and just give everybody some background. There we go.
Sure. Well, yeah, I guess, hey, Ryan, do you want to kick us off, give everyone the 30,000-foot overview?
Yeah, that's fine. I know a lot of this first time on Capital Discussions, I think, but obviously following you guys and known Tom, you guys for a while. But yeah, I've been trading options probably for the last 12 to 15 years. Started Blackpier Capital in 2010, trading kind of proprietary money. And currently, Blackpier, we have a private fund that we run for our partners. And so we run a lot of the strategies or types of strategies that you guys kind of work on through Capital Discussions. And so we're constantly looking at volatility and skews and all the stuff that I guess everyone's been talking about over the last few months. Started Blackpier Capital. Wayne and Tyler. Tyler came aboard with Blackpier a couple years ago. Wayne came aboard about a year ago as well. So we also have Zach Showalter's 15-year prop trader out of Chicago with us as well to kind of round out the team. So day in, day out, we look to trade options and try to break our strategies, make them better, and create new ones. So that's kind of a 30,000-foot view of what we do. And what I currently do really within the team is kind of be kind of a liaison between our strategies and our trading focus and execution, and just the business side of having a trading shop. So, with client development and new partners, and just making sure everything's running smoothly. So kind of an overall kind of president CEO type role is kind of what I've kind of gone into now with Wayne and Tyler really taking the reins when it comes to actually execution and trading and new strategy development. So that's kind of my story.
Cool. Just curious, where are you guys at?
Me and Zach are located in Tennessee. Tyler's in Sacramento, and Wayne's in Seattle. So all over.
Nice distributed company.
Absolutely.
A modern company, that's for sure.
You got it.
Tyler, you want to take the next one?
Sure, yeah. So I mostly head up trading and execution. Really, what that is I make sure that all the research that we do, all the back testing that we do, and the strategies that Wayne and I and Ryan help create gets implemented into the market the way it's supposed to, so that what we're doing in back testing is exactly what we're doing in our live trading. And we spend months of research just to develop a single strategy before we even put $1 in it. And when we put all that time into the strategy, we need to make sure that we're executing it exactly as we back tested it so we can get the results. Because if we start doing things like, oh, maybe we'll just change this right here because we have a feeling about the market. Well, that little change that we're making that might not seem big is actually changing the risk reward of the trade, changing the outcomes of the trade. And if we do that, then all the back tests that we've done is kind of worthless to us now because we're changing the trade. So that's really where my main focus is, just making sure everything's traded the way it needs to be. And when I was first starting out, when Ryan and I were first starting out, that was probably one of our biggest focus and one of our biggest realizations. We just need to trade our systems, and we're almost operators of our systems. Like, they're separate from us. It's not us making the decision. It's saying like, this strategy is going to do this, so we're just the ones clicking the buttons. We're almost like the worker bees for the strategy. And it really is a lot about they working in a team. It helps you keep you accountable for making the trades and making sure you're doing what you need to. And so, yeah, it's working in the team environment with Ryan, Wayne, and Zach. It's really great because it forces you to go to the next level and to make sure that you're actually doing what you should be doing and not going off of your plan.
I know this is a crazy question, but I see 3 pictures, but I don't know who's who.
Oh, I'm on the very left. Tyler's in the middle. Wayne's on the very right.
Okay, great.
So the good-looking one's on the left, and then the other guy.
You see how it is, Ryan?
Well, that's why we stay behind the computer. We're
Face for radio, right?
Yeah. We let Ryan go out there in the public. We stay in the cage.
There we go.
And then, to take it off from there, I'm Wayne. I'm on the far right, the only one with a tie. I head up research and development. Pretty much, not only do I try to break our strategies, I try to optimize our strategies. I try to make new strategies. I try to look at the market in different ways. I study business and behavior analysis, so I implement a lot of behavioral analysis cues and analytics as far as that's concerned. Even with new traders that we end up interacting with, it's amazing, the crazy ideas that come out there that a lot of people brush off, and there's always something to them. There's always a new opportunity. There's always something that's changing. And as a lot of older traders know, the markets never stay the same for very long. So we're constantly adapting to the markets, and not only adapting to what's going on in the markets, but foreseeing what's going to be happening. Where is the trends going? Is the skew steepening going to stay around? What changes that? Well, what drives that? Is it Dodd-Frank? If Dodd-Frank doesn't get or gets changed, what is that going to do to skew? Things like that. And just making sure that the reaction there, and making sure that we're on top of it and ahead of it. That's my job, and I love what I do. But like I said, we stay in the cage all day.
We had a couple of questions. Ray asked, how did you come up with the name Blackpier Capital?
That would be for me. So everyone asks me that, which is pretty interesting. So over here on the East Coast, there's a place kind of near Charleston called Kiowa, and you've got kind of the intercoastal waterway. And I was actually sitting on the back of the porch, and when the sun goes down, you've got the intercoastal and you've got piers out there. When the sun goes down, it looks like a black pier because you've got the shadows on it, which is pretty cool. And kind of the way the feeling was, and kind of sitting there looking at sunset, it was pretty awesome. So I was like, Black Pier, that if I can give anybody I work with or anybody the feeling of having that kind of being on the porch of Kiowa staring at sunset, and that's what I want to do. So that's where it came from.
Very cool. And Bodan had a couple questions. He was on the CME floor, I'm pretty sure. And yes, what markets do you trade? Futures options, equity options. What kind of stuff do you guys focus on?
Yeah, I mean, we're primarily like a lot of the other guys, and we obviously highly liquid. So the Russell, the SPX is really where a majority of our volume goes through. With kind of our private fund, we have current strategies, and obviously we have our proprietary capital too, which with that, it's a little bit more freelance with what we can use and how we kind of look at it. Like Wayne was saying, we kind of look at all different types of ways to make money. So, but primarily, you're going to look at we're mostly options and really kind of looking more into Futures options as well. I've been using those, and not so much futures but that may change in the near future. So that's primarily what we use is the broad-based index options.
Right, and I'd like to add, we do play in like the butterfly sandbox, and that's the structure that a lot of us were brought up on. But as our tradings progressed, we've gotten outside of just like strictly butterflies to where it's not necessarily like we're trading certain structures. Rather, we're just trading options in different places. And one thing Wayne and I are always looking at is not necessarily what kind of structure can we put on that has a name, but just where's the most optimal edge for us? Where's the best place to put our longs on the skew curve, or where's the best place to place our shorts on the contango curve? It's more, we're just trading a conglomerate of options that pairs together that doesn't necessarily have any defined a structure that's traditional, but it's just what's the most optimal edge, where's the best place to be putting our options at this given time and in this certain market environment.
Right. That goes back to, I'll add on that. We're in, low volatility relative, right? And we're not like in extremes, but some people would say we are, but the edge is starting to turn where maybe going positive theta isn't as beneficial just because your risk has to be so extravagant to get, pennies. So now you're picking up pennies in front of a steamroller. And what's great about that is eventually the switch gets flipped and volatility starts to come back, and you definitely don't want to be on the other side of that when it does. And so just, keeping your mind open to, sometimes positive theta or when you're trading options. I know a lot of people get caught up in the quote unquote income game. And, really all income is just trades that work progressively over time. And you got to change with the markets, like I said. And when you go extremely low volatility, the odds are that it's going to come back, and it might stay, but that's what risk management's all about. So we just place where there's most edge sometimes.
Yeah, brought in another question. What front end platform do you guys use to execute your trades?
We use Silex.
I think you guys stepped on each other. What was that?
Silex.
Oh, Silex. Okay.
Yeah. So, yeah, we've used quite a bit over the last utilized anything from softwares you can allocate prior, post, all that. But when it comes down to moving a lot of options around and stuff, Silex tends to be one of the better ones. Not cheap, but it's one of the better ones.
Let's see. Can you guys see the chat? There was another one here.
Yeah, I can see it. There was one that was talking about entering. I've heard that to enter and manage a bearish butterfly trade, Ryan Moffat does not use Greeks, but only value of the index and price of the butterfly. Is that correct? Ryan, actually, you want to take that? I can take it if you want, but
yeah, it boils down to really not the bearish butterfly, but kind of like Tyler mentioned, all our strategies. And it, and a lot of times, and it's kind of interesting, and Tom, this better than anybody, it's, you get, these certain structures and names of structures, and I'm trading this or trading that, and literally all it is a manipulation of risk and exposure and the T+0 line and all that. So, and once you kind of get to where you're moving around a bunch of options, it's literally having the experience to understand really where your risk is, because the models they're flawed. Whether it's option view or one or toss or whatever, they're all flawed models because they can't predict how the skew curve is going to react. So when he's talking about managing a fly, not by the Greeks, but value price index, what that comes from is just trading a million flies and understanding in certain moves, generally how the skew curve moves or how the value of the fly moves, and understanding in different environments, understanding what that fly is going to give me with range, or give us with range, or how it's going to react. And again, it's when you see something over and over and over with live tradings, with research, you start to understand, and literally the model in the Greeks, you don't really need them anymore for the most part, because it's not really about that. You understand how it's going to how it's going to operate. And two, the Greeks at any one point doesn't really mean much to us anyways, because it doesn't tell you what's going to happen. And again, the models that we use, and hopefully everyone out there knows that regardless of whatever platform you're on or model you're on, it is inherently flawed. And having something boil down to, one data point or a couple data points, generally it's not going to work over time. So it's having that awareness and that experience, or doing the work and the research in order to just really get a good feel of what that fly is all about, and the components of the fly, what each option is doing and why. I mean, this is something that, Wayne and Tyler are incredibly good at. And I think with Wayne's background in an auto tech, of basically being able to take apart a car and put it back together, is huge, because people understanding the underlying options and how they're affecting the entire, quote unquote structure is incredible. Because what you can do is you can start optimizing that, just like Tyler mentioned, of saying, okay, do I just want to put a 50-point fly on? Or let's look at the components and maybe having a 60-point, because I'm getting the skew curve in a better place that will hold up better with my longs, or a place with my shorts that will degrade quicker because of the way the skew curve is and the contango is. So you start getting a little bit more familiar with exactly how your options are going to work, because you're not just saying, hey, I don't need to, rebuild the engine in order to drive the car. But if your car breaks down, it would be really, really nice if you did know how to rebuild the engine. And that's kind of where we're at, is, when with Wayne kind of talking about the markets always change. Well, if you don't know how your structures are working, or the underlying options within the structures are being manipulated by the skew curve, you don't know how to change it when it's not working anymore. So like Wayne mentioned, with a very low volatility, and you have to put a lot of risk out there, well, what's wrong with just flipping that? Yeah, you might be negative theta now, but maybe that's the trade we need to be in. Maybe not. But having that awareness, and it does boil down to, not saying we don't use Greeks at all, but it is one of those where we feel that we need to have enough data points and experience to know what the trade's going to do in different environments, where we don't need to depend on the models. So long answer to a short question. So apologize for that.
No, yeah, I mean, you hit it on the head. I mean, models, as far as, I mean, and everyone's got their proprietary models. You got Toss Smile, you've got Option View, you got O&E. Really, if you look at a T+0 line, I personally think that you should look at a T+0 line with Bollinger Bands. That would help so much, or a cloud modeling of like an electron cloud. It has a probability of landing somewhere in that area, and as you get further and further away from where you are, it's more inaccurate, and because it depends on how it gets to that point. But anyways, yeah, I mean, just to add along with the modeling, it's just incredible that I don't think it should ever be a T+0 line. It really just needs to be a probability curve. So
right, and that's why when we're back testing our strategies, we go day by day. We could automate the back testing, but there's something that you don't pick up from it that you get on a day-by-day basis when you're just clicking through an option view or O&E and seeing how the T+0 lines are reacting, how your P&L is reacting for different price movements. And looking at it that way, you get such a better understanding and better feel of what the market is actually going to do and how your position's actually going to react to different market movements than you do if you would just have a backtesting algorithm where it just spits out results. And I think there's a lot to be learned from, spending a month, 2-3 months with a single strategy and learning how it moves and really digging down and understanding, why am I making money here? Why am I not making money here? Because I know there's some times where you're in trades and it feels like, man, there's just money is not coming into this position, or they're not giving me value. It's like, well, why is that? Why is that happening? If you're managing your Greeks the right way, well, maybe there's something else that's causing that. What's underneath the hood of that engine? What's happening to that position to cause it for money to not be coming in there?
How far are your spreads? Where are you on the contango curve? What's volatility doing? What's it doing to each one of your options? You're so right, Tyler. And I mean, we talk about this every day. It is. It's looking under the hood.
So do you see the next question? Can you define what are the main two Atlas strategies?
Oh, actually, yeah, Ryan, you can probably take that one because it's not two. It's elaborated into more now.
Yeah, so yeah, we've got, depends on if you're talking within kind of what we do kind of with our private vehicle, we've got three main strategies, and then we do run an overall hedge in order to hedge any sort of just obviously an 87 type break or anything like that. So it's three main strategies, and they've come out of countless hours of trading live, but also research, and kind of the whole team working on them. So, the three main strategies, we've got the Atlas, the Hedged Atlas, and the Igneous, and they kind of all play certain parts within the portfolio, and those are always kind of optimizing, changing. I mean, right now, I know Tyler and Wayne are right in the middle of, again, trying to break two of the strategies and basically put them back together. We constantly are stress testing, different environments and trying to improve. And so really kind of the Hedged Atlas is going to be a kind of a configuration that, I mean, a lot of people are familiar with, maybe an M3 or those type movements within a structure. So it's going to move. It's not going to have the exact same. It's not that trade, but it is going to have similarities with the movement and of the equity curve of what you would have with that certain thing. So it's going to be more hedged to the upside to give a little bit more smoother move to the upside, but the overall results or the overall return is going to be lower than actually our other two strategies. The Atlas itself is going to have similarities to like if people are familiar with like a bearish fly or anything like that, what's unhedged. It's going to have similarities to that, and that's kind of where that ends, because the way we do it is going to be quite a bit different than probably what a lot of people are used to with how it starts and manipulates throughout the trade. But what that does is it does vary extremely well in volatility, kind of eats that up for breakfast. So it does very well. So it plays a certain part within our portfolio. And then the Igneous, which is it's just flat out alpha generator. It takes, so the Atlas and the Hedged Atlas are very mechanical. The Igneous definitely takes market environment into account. And it really, it's pretty incredible. It will manipulate itself with the market environment, and generally, I call it a time trend follower, because literally with the Igneous, we're either going to be in a bullish, neutral, bearish position, and generally we're right 53% of the time, we're wrong 47% of the time. But it literally is cutting your losses short and letting your winners run, and by far it's the biggest overall returning strategy that we have. But it swings around quite a bit. So what we do is we kind of put all three of these strategies together in a certain allocation, obviously utilizing portfolio theory in a certain allocation to give us the exposure, the equity curve, and the drawdown that we're comfortable with and our partners are comfortable with. So they all play different parts within that. And then, like I said, we're also creating, and that's just within our main portfolio. On top of our proprietary money, we've got, what do we have, guys? We've got probably another 3 or 4 strategies that we run on top of that.
Yeah, at least, yeah. I mean, and there's additions that are in the background that just haven't made it in yet. We just need to finish vetting.
Yeah, so it's one of those where what we try to do is we try to put together a portfolio. If you guys are familiar with Bridgewater Associates, it's that theory where we want to get 10 to 12 to 13 uncorrelated strategies together that obviously eliminate almost 90% of the risk of the portfolio and boost returns. So that's what we create. Now, we look to create it with options, and you can have different exposures, but obviously utilizing futures options. I mentioned futures as well. So that's really what we do day in and day out is consistently look to create strategies to add to this portfolio. We're not looking to make just a trade that does everything, because no strategy will. But we're trying to put together a portfolio of strategies that pretty much, again, eliminate as much risk as possible, but also return. Is we look for highly returning strategies, which is kind of a lot different than a lot of, especially more institutional, is people are looking for lower and lower volatility, which is fine. We want that within our portfolio, but within the portfolio, we want some even volatile strategies but we need to understand underneath the hood how they work, how they play off the other strategies. So it's a lot of counterintuitive stuff, especially from some of the people we've talked to, that we're looking for versus some other shops. But yeah, so our three main ones, kind of what I described, and the other ones, we've got about 3 other ones that are that we use personally in our proprietary money. And then, like Wayne said, we've probably got 3 or 4 in the test kitchen right now. It's a lot of work.
Okay, next question is, what kind of hedging, if any, do you do? That's kind of a hot topic in our community always, about hedging your portfolio of options.
There is. I mean, hedging is, and actually it's kind of surprising because I mean, it's very, I think I've gotten more questions on hedging and people reaching out to me about hedging recently more than any, I mean, even institutions. So, hedging it depends on what you're hedging. Are you hedging delta? Are you hedging volatility? Are you hedging, it just depends on where your risk is. And our risk moves a lot. And so, sometimes our strategies are hedging each other, which is fantastic because then your hedging is basically positive expectancy. And sometimes they're not. And so, we can use are you trying to hedge like a 1987 move, or are you just trying to hedge like a 10% down move? And that's kind of the question that I've gotten, is just what are you trying to, what's your overall hedge? Well, if you want to talk about our overall hedge, is it protects against, a 20% down move or a 15% down move and an increased spike in volatility, because that's what something like a 1987 would do. Now, as the skew gets steeper and steeper and steeper, it's more and more difficult to hedge against that, which is probably what's going to continue to happen. So then you have to just start doing some other crazy things like, hedging with volatility products if you're trying to hedge volatility without trying to kill itself over time. Because currently, right now, I mean, if anyone can do it, I talked to a few financial engineers, but you can't replicate the VIX in a portfolio. And the only way that you can even kind of come close to it is you got to incur some sort of rolling degradation or some sort of contango issues that you're starting to have. So in our overall hedge, like I said, it kind of changes depending on what's the size of the fund, what's the assets doing underneath it. But it does have an extreme tail risk protection against it. But yet again, it is proprietary, so I can't give too many details away.
Right, and I think an important question to ask yourself is, when you're hedging, is this hedge positive expectancy? Is it adding something to my strategy, or is it taking something away just to make you feel better at night and be able to sleep? If you need that to be able to sleep at night and to be able to trade, then recognize that it's there. But I think you should, when you're hedging a portfolio, you should look at, okay, so maybe is this costing me maybe, $500 a month to hedge my portfolio? And then ask yourself, if I left that $500 in my trade and compounded that, and I had an 87 crash, or had something like 2008 happen where you have, a 10, 15, 20% pullback, would I still be up more money if I didn't hedge versus if I was hedged? And kind of compare and contrast to it. I mean, you'll have obviously have a pretty big drawdown, but if you're up more money than if you're unhedged, then maybe you're better off if you're okay with that pullback. And I think it's still a good thing to look into different ways of hedging a portfolio, but just making sure that it has positive expectancy by itself, and that every strategy that you put into a portfolio has positive expectancy, so that you don't have a drag on your returns.
Yeah, I mean, there's still no greater hedge than, sizing, position sizing. If you're worried about hedging so much that, just pull some of your money out of the market and still make gains. I mean, it was something when I first started trading, I had someone tell me it's always easier emotionally to handle missing out on profits than it is to take losses. And that's always true. You know, if you put some money on the sidelines, and yeah, if you miss some profits, it is what it is. But man, if it went the other way, it's much worse of a time. And with compounding, it does not make it easier to scale when you take massive losses. You know, of course, Warren Buffett always, you know, don't lose money. Well, that always goes. Don't lose. It's harder to make it back. You know, you lose 10%, it takes, or if you lose 50%, it takes 100% just to get back to break even. So it's a big thing to know.
Yeah, I'd like to underscore a point that Wayne just talked about is having cash on the side. If you have a goal, so like let's say you have a strategy that returns, we'll just call it 10%. Your goal for the year is, 10% return. That's a good return for you. You're happy. And so one thing you could do is, and people tend to shy away from high volatile strategies or really quote unquote risky strategies and say, oh, that's too much. That swings around too much. Well, let's say you had a strategy that returns 100% a year, which it's not uncommon to be able to find a strategy that does that or develop it yourself. And you can position size that in your portfolio to where, so let's say that 10% strategy, that requires all of your cash. And the strategy that will return 100% also requires all of your cash. But if you traded 1/10 of that 100% returning strategy, now you have the same exact return. So you're still getting 10% to your overall portfolio, but now you have 90% of your cash on the side that you can then go and either keep as cash for a hedge and use that, or you can go out and use some of that to offset some of the returns of that other strategy to where you now have two uncorrelated strategies that are higher returning and lower risk within a portfolio. So it's one way to look at hedging, once again, is using cash and position sizing volatility within a portfolio and being okay with having a lot of cash on the sideline and running a really small and concentrated, highly returning strategy.
Yeah, I mean, Tyler hit it, and this is something that we deal with and we have conversations with kind of family offices is the mentality and kind of the institutional mentality is having all your cash in something very low. And what you start seeing, and maybe in the near future, if volatility ever peaks back up, is you've got these very passive, low volatility type things that, yes, they're very low volatility, but the more highly volatile strategies tend to bend and not break, while the low volatility you pour all your money into are a little bit more rigid. And so if you get something outside the parameters, if the market kind of goes crazy, they end up breaking. So you've got all your cash at risk with something that's very fragile. You read books from Taleb and everything, Anti-Fragile. He talks about this, of having something that will bend and not break. And unfortunately with that, and the way we view volatility within a strategy is we view that as opportunity and flexibility. But a big part of that, just like we mentioned, is understanding and getting underneath the hood of the strategy to know when it does well, when it doesn't do as well, what drives it. And so again, that's a lot of the work that goes into it. But just kind of flipping the switch a little bit and say, maybe something that's a little bit more highly volatile, let me look into that and see what's going on and do a little bit more research and see if there's a fit there. Because it's counterintuitive of what most of the industry looks for, which is probably why it works. Because the way the industry works, when everyone piles onto something, your lower volatility strategy is something that is nice and smooth and a nice smooth equity curve. Obviously, that's what we want with a portfolio, but with just one strategy, you tend to need to have something that will be a little bit more anti-fragile.
Ryan, I guess this is another one. I mean, I don't know if you guys are reading the chat, but I figured I might throw this out there. Ryan, this is definitely going to be for you. There's a couple on here that are just asking what's your ROC monthly. I don't know if that's per trade or if they're just talking about other performance as far as our private vehicle or whatnot and so forth.
Yeah, I don't know. I guess exactly what they'd be asking. I guess that's Tom. Tom, what?
Well, just return on capital. So I guess if you're an investor in the fund, what kind of return would you expect monthly on average?
Yeah, so averages are extremely deceiving. Obviously, you need extremes to get averages, but generally we look to on a net basis is target about 30 to 35%, and then with a max drawdown of 20 to 25%. That's really what we target with our portfolio for our partners. So.
And that's not monthly. I mean, this guy asked monthly, but that was a yearly number. And
Yeah,
that was
that's yearly. That's not monthly.
Right.
You know, with the way our strategies kind of look to go, we, as a portfolio of strategies with the hedge and everything, we target it with our exposures. So we don't really look at it just on a month-to-month basis. Obviously, we've got our tear sheets and everything that is monthly, but we target it with exposure for the strategies, and that's generally what obviously we've seen with, you know, comfort with our partners and with the overall return. And it gives us some of the best risk reward and the equity curve that we like, as smooth as we like it with the growth characteristics. So I hope that helps.
I had a question. How far out generally do you go with your strategies with option expirations?
Wayne, Tyler?
Yeah, that's so it depends on your strategies because we do run other ones. I mean, generally speaking, the meat of them are about halfway through a traditional monthly expiration. So you know, they start out 80, 90 days out or so, and about halfway through we start getting in on them. But we have more adaptive strategies that it really depends on where the optimal pricing is. And we have models that tell us where the optimal pricing is. And so that changes. Sometimes that can be 17 days from expiration. Sometimes it can be right when the options show up. It just really depends on where the optimal pricing is and what we're trying to accomplish, what kind of exposure we're trying to accomplish. Are we trying to accomplish something bullish, bearish, neutral? Are we trying to capture decreasing volatility or increasing volatility? So it's hard to answer that one in a strict sense, but the mechanical ones generally are about halfway through the option cycle. But those are sometimes subject to change depending on what vehicle we're using. So hopefully that helps.
Yeah, I'm just curious. I don't see any more questions. Do you have any other stuff you want to, maybe common questions that you've gotten from other option traders or clients, and maybe just other topics you want to kind of address?
Yeah,
Well, Wayne and Tyler, both you guys have had a lot of kind of talking about different volatilities and contango. So if you guys want to dive into that, or with me, just depending on what people would, you know, want to hear, it'd be more. We get a lot of emails. We were just on a podcast, and we get a lot of emails on the business side of trading and that. So I've been answering a lot of emails with that, and also treating trading just as a business period. What's very interesting is people want to do this full time, and I'll kind of say this, and then Wayne and Tyler, you can get into what you want to get into, but a lot of traders want to trade full time. And what's very interesting is, for some reason or another, trading, they don't have the same mentality as if you were starting a business in any other industry. And having a trade plan and a business plan on top of that, in order to actually, if you present to someone that you respect and see if they would even buy into that business, is always a good exercise. Because what we see is a lot of traders kind of ask us, well, you know, I want to do this full time, but literally they don't even have a comprehensive trade plan. And that's just a piece of it. The trading is just a very small piece of the business if you're going to do this full time, because there's so much more. Just think about if you're opening up a McDonald's franchise. It's no different. You've got your process for making the food and your product, which obviously McDonald's does a very good job of their process. But then all the other ones is cash flow and really looking at the entire finances of everything. And looking at it from the standpoint of, I think it's a good exercise to look at your strategy, saying, when do these things do well? When do they not do well? Because that's one thing that we constantly work on is have strategies that pick each other up for the sheer fact of cash flow for the company. Because if if your product is returns and you've got a strategy that does extremely well, let's say in higher volatility, but doesn't do well in low volatility, well, you can't just fold up shop in low volatility. You need something that's going to complement that, and you need actually probably 3 or 4 or 5 or 6 strategies that complement each other. And so it's an extreme amount of work. It's so much work. And if someone wants, the one thing is, if someone wants to work less, don't get into trading full time. I mean, That's a fact, and that's something is literally trading full time there's more work that goes into it, but obviously the rewards are sky's the limit for rewards. But it's something that I've been kind of answering a lot of emails on that we've been getting from our podcast, and it's something that I think if someone would have told me that 15 years ago, I think it would have definitely at least sparked some questions in my head to say, okay, am I really ready to trade full time, and what type of work do I need to do in order to kind of get there? But that's something that I've been dealing with, so I don't know if that helps anybody out there. But from my standpoint, that's over the last couple of weeks been dealing with.
Yeah, I mean, trading's always it's a fun subject. Ryan, there's another question that kind of popped through that I think will be the last one that we'll kind of throw at you, and then it looks like a lot of them are technical, so Tyler and I will just have fun. But they were asking about what our performance is year to date, how much AUM.
With kind of talking about the fund and everything, if the easiest things, because that stuff is pretty easy. If they just want to email us at info@blackpiercapital.com, it's real easy to answer all the questions, kind of referring to just like the fund and that stuff. I think it's a little bit easier, and that way Tyler and Wayne can kind of talk about probably something that's a little bit more helpful to the traders. But info@blackpiercapital.com. It's right there. So just shoot any questions with regards to, we can talk about anything with AUM, all that stuff. So.
Right, because I mean, it's. I mean, I know a lot of people get excited about the fund just because it does perform in very adverse ways to traditional portfolios. But yeah, I mean, as far as trading goes, we had a guy on here, and Tyler, you can help me with this one, that was asking about how do you place your legs for optimizing profitability based during skew curves. One thing that I kind of want to put out there before we start getting this heavy into is it depends on what you're trying to capture with the skew curve. Are you trying to capture a continuation of a steepening skew curve, or are you trying to capture the most volatility drop, or are you going to are you wanting to perform well if the volatility spikes and there is a steep skew? So, I mean, no matter what, whenever we are creating a strategy or creating something that is attempting to grab an edge, there's some sort of purpose behind it first. So, for instance, I'm just going to give you a broad answer, and I will get somewhat specific, but say you're in a steep skew environment and you're anticipating it to stay steep or go steeper. And Tyler did a presentation on this, and as far as skew goes, and then I know that I did a few on the beginners trading group on capital discussions. But if you're trying to capture a steepening skew, what's beautiful about the derivatives options market is that in front of the money drops out incredibly fast. And when options first open up far out from expiration, the calls have to compensate for that because the skew is steepening as it goes into expiration. And then roughly about 20 days or so, the skew starts to get more V-shaped. So it starts to kind of suck in a little bit. But if you're trying to optimize something for like a steep skew and you're expecting it to stick around, sometimes not having your shorts on the put side is beneficial. So you go kind of far out from expiration, and maybe some sort of a condor structure or butterfly structure or something like that, where you manage your risk properly and you don't put too much capital in it. In front of the money, far out from expiration is extremely extremely robust during a steep skew environment. And then on top of that, if you start to add some sort of adjustments to it or some sort of a risk-off approach to it, for the downside, if the market does start to scream down, you tend to be in a decent position because most of your risk is to the upside, not the downside. So things like that, as far as placing your placements, and just keeping mindful of where the skew is. And Tyler's, fantastic as far as what skew's going. So if you want to take anything from there, Tyler, go for it.
Sure. We did have a presentation a couple of weeks ago that if you really want to get in the details, it covers quite a bit. But I can give a general outline of kind kind of how to start thinking about Skew, how to use it. We use OptionNet Explorer for our Skew back testing. We just found it to be the easiest. There may be other ones out there to use, but we just prefer to use OptionNet Explorer for our Skew back testing. But here, hold on, let me just a second. All right, let me just pull up a blank slide. All right, so let's just draw out like a basic Skew curve, and we'll go through the steps of it. So our axis, well, why is that not drawn?
Just need to click more times.
Yeah.
There
we go. Okay, so we have our axes.
Don't mind the kindergarten scratch.
Yeah. So we got vol over here on the left, and the bottom's gonna be our price. And we're gonna pretend we'll just call this the S&P 500. And you're gonna have, generally the indices have the same looking skew, but it can vary quite widely once you start getting into individual names. But generally you have a skew curve that looks something like that, and the middle of it being about right there. And so on the left side you have your puts, out of the money puts, and on the right side you have your out of the money calls. And what this is graphing is the individual volatilities for each option. So each option has its own vol with, these are left side's put volatility and right side's call volatility. And for me, when I was first studying Skew, what kind of really brought everything together for me was understanding how Skew affected the price. Because when you're just looking at Skew by itself, it's showing you, at least to me, it's showing me the demand for options. So if you think of each individual point, so let's take this point back here, we'll just call that right there. So that has a higher volatility, or I see it as having a higher demand than, say, something right about here. But just because but we know that when you're really far out of the money in options, the value isn't as high. There's not as much money there. And we think, oh, if it has more demand out there, why isn't it more expensive than something, closer to the money with less demand? Well, that's because of probabilities. And so the two things that ultimately determines the price of an option is the volatility in it and the probability on top in it too. And so when you combine these two ideas, you get like this price skew concept of how is the volatility affecting the price, and how skew affecting those probabilities. And so generally in a rising market, when the market's going up, you're going to get a steepening skew curve, and probabilities are getting tighter around the market, so there's not going to be as big of a movement, and that can create some problems for structures like a butterfly. And so, let's draw on and pretend that we're going to be in a steepening skew environment and see what that looks like. So for steepening up, the curve is going to look something like this, where volatility is increasing for a certain strike, but getting pushed closer to the market. And so if we have ourselves a butterfly on top of this, let's look at the individual points and see, why is a butterfly being dragged down? We'll grab a different color. So if we draw ourselves a butterfly on top of this, let's say we just center it right at the money. So we have our butterfly, and so we have our longs right here, shorts, well, I was off a little bit, shorts right there, and then we have our longs right out here again. And so this back leg, when we're thinking of strike placement, and this is what we were kind of alluding to earlier, is looking at, it's not necessarily a 50-point fly might be the most optimal, but you have to look at skew and the contango curves to know where's the most optimal place to put your calls or to put your longs and shorts. And that's why we don't necessarily always look at the Greeks, but more or less look at the skew curves and the contango curve. So back where this long is, if the volatility is being pumped up right here, that that leg is going to hold up in value because the skew steepening and it's the volatility is increasing for that strike. But also remember, as time goes on, probabilities are going to shrink in on the market, causing the actual price of the option to drop and decay a little bit. So you have two factors working for you: a pump up in vol, holding it up in value, and a drag on the probabilities going down. So this for this example, we'll just say that this is going to hold up in value and be relatively stable. For our at the money, we're getting a nice drop in volatility. So that's excellent, and we're placing this strike. We could look at optimizing where is the largest drop that we're going to get. And to do that, I would recommend looking at a contango curve as opposed to looking at the skew curve. So instead of looking at volatility in a horizontal sense or a vertical sense, you're looking at it in a horizontal sense. So that's why we mentioned contango. And I think one way to do it, at least helps with me, how I like looking at it, is using skew to place your longs and using the contango curve to place your shorts. And then for this outside long right here, since we're long this and we're actually having a bit of a drop right here in vol. So, and this is why steepening skew can be challenging for butterflies, is because you have two things working against you out here. You have probability shrinking in, causing this option decay, and volatility working against you. And so then that can start leading to questions of how do we protect against that? What kind of trades can we make to prevent this drop to where now we're actually getting more risk to the upside than our original model said? And that's, again, why we can't really trust option view all that much, or O&E or TOS, whatever modeling software you use, because it doesn't know how to model out the steepening of the curve. And that's why you can get into a trade and it can start out great. Then, 2 weeks later, you have enormous risk to the upside in your trade that wasn't necessarily then when you're first modeling out. And so this is just, I hope this will kind of get you guys into looking at skew and knowing that in order to really understand your trade and to, like we're saying, open up the hood of the car and understand how the engine works and how to rebuild it, this is what we're talking about, and start looking at the individual points of your trades. Because if you're just trading a single option, that's relatively easy. But once you start getting into these more complex structures, just even using 2 or 3 strikes, you have to start looking at both skew and contango.
Right, and not complicating it to the point where you don't understand anything, because it's a balance. I mean, someone asked, what the contango of the structure is. Well, I mean, it depends on how far out from expiration you would be. I mean, if this is 80 days out from expiration, the longs on this are going to degrade extremely quick, and the shorts are going to hang on quite a bit. So, you're not going to get a ton of theta in this position particularly. If it was placed back a little bit, it'd be more in balance, which is why you see things like a road trip or something like that. They tend to be placed extremely far out from expiration. They're not traded close in. It's because the balance isn't there. So it depends on what expiration you're in and where you're trying to grab. Are you trying to be positive theta, or are you trying to not be positive theta? So, sorry about that. But contango is a whole different animal, and we can talk about that another time. There's a lot of other questions on here, and so I just kind of want to get through some of them and not stay on one subject for too long. So there's a question on here about how do you apply a hedging strategy to using VIX options. Just to give you a quick example and not to go too super complex on you. The VIX options don't behave like normal options because they start pricing in very funky things. So if you try to go too far out from expiration on VIX options, they will not react like you believe in a volatility spike. They will severely degrade the value of those options. They're Euro style, which is very similar to derivatives, but they don't have to give you what the expiration line is, because it's fair value. You can't exercise the option, so they don't necessarily have to pay you what the value of that expiration line is, even if you go extremely deep in the money. So beware of that if you're trading VIX options for hedging. The only way that you can really be accurate on what your VIX option is going to pay out is if you start getting closer to expiration, like weeklies and things like that, just because they can't mess with your extrinsic value that much because there's nothing left in it. There's no time left in the option anyways. But then you have to deal with the fact that they misprice those options, or I shouldn't say misprice. The demand for those options makes it mispriced. So you've got to fix that. And normally just doing some sort of credit spread on something that takes advantage of the roll cost of the futures, something like VXX or UVXY, or even going short front month futures and long 3-month futures or something like that to take up the cost of those weekly VIXs that you're buying is a really good way to hedge without costing yourself too much. But either way, definitely keep position sizing in mind, and don't trust your hedge. Even though the hedge is there, don't trust it at all, because things can do it, and markets sniff out weaknesses. If you think your hedge is going to perform extremely well in a 1987, I know it sounds crazy, but what if we drop 20% and volatility doesn't go up, or what if volatility is so baked in out of the money options that they don't spike when they get to in the money? What if the skew doesn't change? Just crazy things that doesn't sound like it's possible. The market will sniff those things out. We didn't think it was possible for 1987 to happen. We don't think it's possible for, this is a new mind-blowing concept that is interesting. What if we had a 25% melt up in a day? Is that possible? Is anyone hedging against that? It's just a crazy idea, but it could happen because, what if everyone's trying to short volatility right now, short premium, trying to find growth, and we have a big spike up in a day and institutions have to buy back all their shorts, and it just is the most massive short squeeze you've ever seen? It's possible. But anyways, so don't trust your hedge. What type of option strategy do we suggest to a new options trader to focus on first? Anything with paper, anything that you trade a lot, I would say. Tyler,
I always kind of dig in with kind of newer options traders is, if you can get some software to back test, it always helps. And just do a regular, what's easy, do a butterfly every month and just get certain rules. Let's say 30 days out, a butterfly, and take it off put it on, at a certain point, take it off every month for 10 years in your back test, and just to learn, just to see how it reacts in different environments and take notes throughout that. And so a lot of people are like, give me a structure so I can trade it and instantly make money. And again, if someone's in this for the long term and they're wanting to do this and be profitable consistently, you've got to learn what a strategy is, why it's working, why it's not working. And one of the best things that we've always done and talked to new traders is just put something on consistently for 10 years. If you've got your back testing software, and just take notes and just continue to watch it. And then, when you guys, Capital Discussions has so many obviously good videos, you can kind of see the different structures. Well, you're bringing a lot more knowledge to the table of like, okay, I understand why this is operating the way it is now. I think a lot of people start with these big complicated structures, and then when it doesn't work like they think it will, then they either move to something else, move to another trade, or just kind of abandon it altogether, which isn't the case. No trade's going to do well in all environments. Just understand when it does well, when it doesn't do well. And I think a lot of that is just repetition and doing the work on the research. So I think that was helpful for me, is basically just saying, okay, I'm not going to sit there and try to make money. I just want to learn for the first few months or even years. And if you do that, you take the pressure off yourself and you really dive in and start learning the game. Because there's a million different ways to make money in this market. You just got to find one that kind of works for you, but you just got to put in the hours and put in the work.
And I know there was a question earlier about a podcast. Do you have like a URL for that or someplace on your website?
Yeah, if you actually, I think if you go, it might be on our blog. I think we post all that, so you can see the videos or podcasts we've been in. So, and we talk about all kinds of different stuff. So anything hopefully is helpful to all and any of the traders. We'd love to hear any questions, obviously with any of that. But I believe we do have that up with that podcast. So just go to our website. It's on our blog.
Okay. Well, I think it's time to roll the Jeopardy music. So we're about at an hour. So we like to not go too far over to keep people's time respectful. So, gentlemen, thanks for coming on. It's a pleasure. I'm sure we can have you back on in the future. It's always good to have a nice discussion about options.
Yeah, thank you so much for having us.
For having us on. Thanks, Tom.
All right, and thanks everyone. We will see you next time. Thanks again.